I'm betting on at least $200 an ounce, but we could see a spike that goes up toward quadruple digits. I don't think this 661 that this chart is pointing towards as an echo. This is like history repeating. It's an echo from the past and just adjusted for the devaluation of the dollar. I don't think it's unreasonable.
The main issue people need to prepare for is a credit freeze. Yes, from a financial standpoint, in my opinion, there is no better places to be than in hard assets. I will not waver from that. Silver will remain my favorite asset until a time where I can't even imagine it won't be.
Silver is entering one of the most powerful structural phases in decades, supported by tightening global inventories, accelerating physical demand, and a monetary system losing credibility by the day. Analysts see pathway targets beginning at $200 an ounce, but the extreme supply-demand imbalance has also opened room for far higher spikes. Some chart models even point toward levels around $661, viewed not as unrealistic speculation, but as an echo of past blow-off phases once adjusted for today's dollar devaluation. With industrial consumption rising and physical delivery draining exchanges, the broader setup resembles the early stages of a historic bull cycle. Mike Maloney, a respected educator in the field of precious metals, and Gregory Mannarino, a prominent macro analyst, emphasize that silver's monetary resurgence is occurring at the exact moment when fiat currencies and debt-based systems are showing deep cracks. They highlight how central banks, especially those in the East, are aggressively securing gold and positioning themselves for potential structural weaknesses in the global financial system. Some, such as Russia and India, are even moving towards silver in ways not seen in decades. At the same time, investors are pulling metal off exchanges, retreating from paper ETFs they no longer trust, and accelerating the squeeze on already thin physical supply. Industrial demand from AI systems, solar expansion, batteries, EVs, and advanced manufacturing continues to exceed production, all while years of structural deficits erode remaining stockpiles. With these forces converging, the prospect of silver reaching triple digits and potentially the $600+ zone during a future blow-off phase becomes increasingly aligned with market realities rather than speculation. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Central banks aren't complete idiots. I mean, they are pretty dumb. They do stupid things. They have corrupted the world economy. They keep us chained into this absolutely flat out evil monetary system that enslaves us and always produces more debt than there is currency to pay the debt. But like I said, they're not completely stupid. They know about the gold-silver ratio. They know that silver is incredibly undervalued. They have been accumulating gold. And, one of my strategies has been to accumulate silver now. And then at certain gold-silver ratios, I'm going to be turning some of that silver into gold. I think a lot of the central banks will be looking at around trying to accumulate more gold, knowing that there is a problem coming with fiat currencies and just the monetary system in general, the markets and so on. And the best way to get ahead of the curve is to try and get as much gold as possible. But with gold already up at the prices that it's up at, they're looking at that thinking that, even though it's at record highs pretty much, they're looking at that thinking that that's a high, where silver is still basically at its 1980 high today, which just doesn't make any sense at all. Well, it's a metal that tech has to have. Tech can't get by without it. And at the same time, we're starting to see monetary demand, and this will increase as time goes on. We haven't seen the West interested. The West was selling while the East was buying, which I think is sad to see. But this is the one I was wrong on. I said that the central bank had actually purchased. And what they've done is India takes a historic step toward the remonetization of silver. They've made silver a metal that can be used as collateral in loans.
Russian central bank absolutely buying silver.
Yeah.
They're leading the way, and they may incentivize others.
And if it goes down to, say, a ratio of 20, it means that they will be able to get over $2 trillion worth of gold for this $535 million that they spent on silver. So, they're not completely stupid. The headline should say that the central bank bought tens of millions of dollars worth of claim checks that represent, there's supposed to be representations of silver. But like I said in that original video where David asked me about this, SLV and the other ETFs, I just don't trust them. And the reason I don't trust them is because I read their prospectus and their 10K filings. Silver is an incredibly important metal, and China is a major supplier. And that means that they can squeeze all of the tech, all of the AI infrastructure that's going in, all of the solar and batteries and things to power electric vehicles and so on. This all requires silver. And if the West is using more than it produces, and the world is using a whole lot more than we produce, stockpiles are getting low, and then China can put a squeeze on us. And this is part of the posturing and the battle that was triggered with the Trump tariffs. People are taking delivery. And so look at that huge fall in the futures. The physical shrunk, but the futures, the bets on physical shrunk by even more. People are not trusting the paper contracts as much as actually having it in their hands. So this is a reflection of investors being more nervous and actually taking delivery, pulling it off the exchange. And not just, it's the musical chairs occurring on the Titanic. And you've seen the movie with the little orchestra, that's a string orchestra that's playing. They do stop playing at one time or another. And by that time, there's not enough lifeboats left. Then there's all this investment in the mining sector. And then it takes years for that silver to come to market. And so that happened when silver peaked in 2011. And the silver started coming to market by 2015, 2018, you saw increases. But then we went back into a structural deficit, even with that extra supply coming to market from all of those mines that were opened up or reopened. And we're running out. We've had this structural deficit year after year after year. And so this runs in these waves and cycles. But I don't know if even at $150 or $200 an ounce, if silver is going to catch up with demand over you look at the AI infrastructure that's being built out and the demand that silver will have on it for all of this tech. And at the same time, people are rushing back to it for investment. And when you invest in something like Silver Eagles, you're taking silver off the market permanently. Nobody's going to melt down Silver Eagles to put into electronics. The premium on them is too high. I've often said that there are these brief moments in history where the precious metals become not just the safe haven asset where they are savings, but the asset with the single greatest potential gains in purchasing power. And that is investment. So I would argue that during this period of time, during the bull market, that it is both savings and investment simultaneously. It's a safe haven, it's savings, it's investment. Not just a cornerstone of national security and energy transition, but it's developing a monetary component right now. And I've often said that that is what is required for the triple-digit silver that I believe is definitely in our future.
Blue across the bottom here is the 1970s, and that's what the blue line looks like. And you see these waves and the big blow off top, peaking around 49.45. This is just daily, not the intraday high, but the end of day close.
Right.
And then the white bull market is the current one. If we go back to 1999, it sort of bottomed in 2001, 2002, around $4, went up to 48, came down, and here we are. We're around 53, 54 right now. This was the high from a week or two ago. I forget the exact date. So we're above the 2011 high. We're above the 1980 high in terms of a daily close, but there's still a lot more to go. That's this yellow line here. I do think we are going to get a massive blow off top in the next 2 to 3 years, going up to something like 600 an ounce.
Wow. Yeah, I'm betting on at least $200 an ounce, but we could see a spike that goes up toward quadruple digits. I don't think this 661 that this chart is pointing towards as an echo. This is like history repeating. It's an echo from the past and just adjusted for the devaluation of the dollar. I don't think it's unreasonable.
The U.S. financial system has entered a phase where the Federal Reserve and Treasury now function as the lenders and buyers of last resort, suppressing interest rates to keep the debt markets from seizing up. With natural buyers of U.S. debt disappearing and foreign governments stepping back, the artificial management of the yield curve has created a distorted picture of market strength. Rising stock prices are masking a deeper deterioration underneath, where real wealth is being drained from the economy to maintain the illusion of stability. Currency devaluation, forced dependency on the current system, and accelerated debt expansion are all reinforcing a cycle that weakens purchasing power while increasing pressure on households. This environment is reshaping every asset class, as genuine price discovery is no longer possible. Only valuations are derived from debt manipulation, suppressed rates, and policies designed to maintain control rather than support economic health. The system's fragility is becoming more visible through declining job numbers, rising stress across the population, and policy decisions that appear aimed at keeping people divided, distracted, and dependent. As credit markets tighten, the risk of a freeze becomes increasingly significant, prompting many to seek hard assets and tangible stores of value as protection against systemic disruption. Let's get back to the interview.
The Federal Reserve and the U.S. Treasury have now merged into the lenders and buyers of last resort. When you have a mechanism of rates being artificially suppressed, who wants your debt? Nobody wants your debt. No one wants their dollars. So the mechanism of keeping rates artificially suppressed and further from here, this is what we're hearing from our president these days, and of course his favorite Fed president, Myron, who probably is going to be the next Fed chair. More currency devaluation on the back of artificially suppressed rates. So it makes, the Fed and the Treasury here, the lenders and buyers of last resort. There's nobody left here. Natural buyers of U.S. debt are gone. I'm talking about foreign governments, pension funds, etc. So you got this mechanism. What's happening is obviously a complete management of the yield curve, and that is fostering this rip higher in the stock market, but it's all an illusion, and it's just a matter of where is that wealth actually coming from to prop it up, and it's coming right out of the economy. Everyone knows it. It's an incredible mechanism, and I think people are starting to wake up, at least I hope so, on a grander scale, that things are not going the way that they believed that they would, regardless of the changing of the guard behind the resolute test. They could put a farm animal there. It won't make any difference. I've been telling people that since forever. But Greg Mannarino looks at the debt market, man. It's no secret. I don't care. I really don't care at all what the Dow does, what the S&P does, or what the NASDAQ is going to do, what people speculate these things are going to do, because the debt market is going to tell us everything we need to know. And I've been trying to tell people, or explain, and you probably heard me say this as well, that every asset class, I don't care what it is, first of all, there's no real price discovery today behind a single asset. It's all just faked. Again, it's this mechanism of artificially suppressed rates, currency devaluation, and bad debt expansion that everything is pricing off of, quote unquote. So what does that mean for the overall stock markets, which keep climbing higher? It's a derivative. It's deriving the entire world stock markets, not just the one here in the United States, is deriving value from action in the debt market. Therefore, it is the derivative. It's in and of itself, not even talking about the real derivative that's on either side, which are in the quadrillions. It's insane. It's non-quantifiable. Okay, and that goes for currency and everything else in between. So that's all I care about. And the main driver that I look at is the benchmark. It's the 10-year yield. What's it doing? Right now, we're stuck in a range. We're above 4%. It's not going to stay there. It's dropping lower. The dollar, we know it's not going to continue to have even the purchasing power it has now. We still have a president screaming from rooftops that the dollar's not weak enough. We still have a president screaming that the rates are not low enough. And the Fed is following suit here again. It's an incredible thing to witness here. Now we're hearing about these dividend checks. Dividends from what? Look, people are too I don't know what it is, lazy or whatever it might be. Just do their own research. According to the Congressional Budget Office, the U.S. Treasury, we've taken in at a maximum of $195 billion with regard to tariffs, where Trump is revenue. What he's talking about is now these $2,000 dividend checks going to cost us $400 billion. And where's the difference coming from? Well, the Federal Reserve, of course it is. It's just all a deception on a scale I've never seen in my life. And I was no fan of Joe Biden, and I really didn't like the man or his policy. But this guy, he was selected for a reason. There was no election, as we all know that. And just in case people are now wondering, these are the guys that Trump is going to be meeting with here. He's scheduling a nice gala dinner here for J.P. Morgan, Diamond, and other Wall Street CEOs, the banks. And everyone knows, they don't have our best interest in mind at all. It's going to be more of the same, wipe out the economy faster. And I also believe, and it's already starting, the propaganda machine, the scripted so-called experts on their shows here, the panels where they don't ask a freaking question. It's an unbelievable thing. And I do it all the time. I see, like, for example, let's say I'm on CNBC. What are they talking about? Either simultaneously or within a half an hour, they have different guests, same narrative, same conclusion. It's all faked, including the data, which we really don't even know what's going on here. But we did find out that last month we lost. They let us know that the U.S. economy lost 11,250 jobs per week. That's what they're allowing us to know. So, guys, look, I'm sitting here preaching to the choir, and you know this better than anybody, but that's where we stand, man. Just people got to get themselves on the right side of this and wake the freak up. And then maybe a stabilization. This is going to be the tell when it's time, when the debt market is finally imploding. But again, they're not going to let it do that. I don't think they're done. I believe that they must create more dependency on the current system. We are going to see further rate suppression, further currency devaluation, a much tougher situation for people who try to make ends meet as they need to create slaves to the current system. So when they roll out the new one, again, it's going to be the same thing. Problem, reaction, solution. It's always the same. I believe they're setting up a situation here where people will become so desperate, again, as this thing continues to be destroyed from within, as we continue to be collapsed. The economy is collapsing. Henceforth, look, the government shut down here. You can't really know what that is going on. Interesting play here, but no one should be surprised how the airports, let's just put this together in the bigger picture. What do? People can't travel. This is the most traveled month of the year. People get together on Thanksgiving to give thanks to God. Well, let's not let them do that. Let's raise their fears, their anxiety. Even if they can get a flight out, let's make them think that maybe they can't get a flight home. Let's keep them separated, divided. Another mechanism like COVID was to keep people separated and divided. But this one is in your face, diabolic. Don't get together with your family. Don't allow them to do it. And make it very difficult for them to do so they can't give praise to God. So keep them separated during Thanksgiving. Don't allow them to talk at the table. Word of mouth is much more powerful than the mainstream media. Don't allow people to talk about the economy again. Keep them separated, divided. Don't allow them to come together because that's our strength. So the timing of all this with the airports, and even if they reopen the government today, they're not going to be able to get all the flights and everything aligned till well after Thanksgiving. And Trump knew that. Made sure the timing is obvious. Anyone who can't see that, spiritually disenfranchised or obviously willfully blind. But that's just too obvious, I think, for most people to understand. But again, with everything else that you were just talking about here, they want it all. They don't want people to have anything, and they want people to suffer. They're breaking them. They're breaking the economy so they can break the people, to get them to accept anything, even, as you alluded to and we just did too, a corporate-backed, overseen by the Federal Reserve financial system, it's completely unconstitutional. There's nowhere in the Constitution that says that we can have a stablecoin token being issued by a private corporation to be used as currency. It's not there. But again, it got right through. Where was the pushback from Trump supporters? Nowhere. So it's time to push back, and that's how I see it. The main issue people need to prepare for is a credit freeze. Yes, from a financial standpoint, in my opinion, there is no better places to be than in hard assets. I will not waver from that. Silver will remain my favorite asset and until a time where I can't even imagine it won't be. I've been talking about metals for 1,000 years. I've never ever once wavered from silver. Period. I think people need it as a financial standpoint. But again, we need to come together as a community because, again, in a lockup situation, this is where we're going, of course, of the credit markets, the debt markets, the flow of credit through the economy will stop transactions, will stop. Debit cards don't work, no access to your cash. Again, this is what they're going to do. Complete pandemonium. Don't worry, everyone. We have a solution for you. President Trump was smart enough to sign.
The current direction of the financial system shows how deeply the foundations of debt, currency control, and policy engineering are shaping the next phase of the economy. As traditional market signals fade and artificial mechanisms take their place, the disconnect between real economic conditions and the narrative presented to the public becomes clearer. This environment is pushing more people toward assets that hold value independent of centralized management, while the broader structure continues to move toward greater dependency and tighter control. The pressures building beneath the surface will define how investors, households, and institutions adapt in the years ahead, especially as the system transitions into its next phase. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.